Welcome back. Well, let's get to an exclusive conversation now. We have Saurabh Kumar, who's a senior analyst, India Banking and Financials Research, JPMorgan, who's joining in from the sidelines of JPMorgan India Investor Summit 2023 to put a focus on the banking space. Saurabh, hi. Thank you very much for taking the time out. Well, I wanted to start with one of the sectors which everybody can't stop talking about, which is the entire PSU banking index that's given returns of around 20-odd%. We've seen a rigorous bad loan cleanup which has taken place, merger of PSU banks which has taken place, net interest margins which have improved. So there is an overall improvement in PSU banks and what they have reported in the past couple of quarters. In your opinion, is that performance here to stay?
Hi, so good afternoon. So for public sector banks, we think yes, this year again we'll broadly see broad-based earnings beat across the public sector banks that we cover, which is State Bank, Bank of Baroda and Punjab National Bank. And this is the only place within the broader financial space which is still delivering an earnings beat relative to expectations, largely driven by lower credit costs. So to that extent, and given the valuations where we think are still at a relative discount, let's say, to periods before 2050, when the asset quality cycle was not there, we think there is still some juice left in the PSU banks, which hopefully should get extracted through the year.
All right, some juice still left in the PSU banks, but let's just focus back to the private sector space. Just wanted your thoughts on India's largest private sector bank post-merger. There were a bunch of disclosures made by them. The impact of the merger, of course, was exposed to the street by the bank upfront itself as against later. How much do you think is in the price right now, and what's your view on India's largest private sector bank and the other private sector banks as well?
Yeah, so on HDFC Bank, we are broadly positive. We are not too worried about some of these hits that they took. In our view, these are all accounting entries. There is no cash impact, and most of this will get reversed over the life of HDFC's book. So I am not so worried about some of these impacts. As we said, these are largely accounting entries. There is no economic impact, and most of these entries kind of reverse themselves out over a period. I think for broadly private sector banks, we think that broadly you should get a period of mid to high teen growth. Valuations are supportive, but earnings upgrades will be hard to come by. The key constraint for private banks is on the funding, which is deposits, and that is where we'll have to watch how the macro behaves. And we'll probably, as investors, also be prepared to accept some margin downsides, which hopefully should get compensated by lower credit cost. But basically, margins have kind of peaked. They will trend down. Broadly, EPS upgrade will be harder to come through. So investors can look through to getting book value compounding. Valuations in themselves are reasonable. They're not excessively expensive, but it will be hard to argue for additional re-rating from here on.
Okay. Well, talking about macros as well as micros, Saurabh, what is your asset quality outlook for the year as well as going into FY25, considering that there are headwinds such as inflation, higher rates, the possibility of a global slowdown? In that context, what are you penciling in when it comes to asset quality for both public as well as private sector banks?
So yeah, I think we'll probably run below normal this year, certainly. We'll start normalizing maybe next year slightly in terms of the asset quality numbers, and across banks these are different. But this year clearly should be below normal, should start reverting back to more normalized levels fiscal 25 onwards. The key question is around the unsecured loans broadly, and that problem seems to be in the low ticket size market, not so much the market where banks operate. So maybe an issue for some of the fintechs or the NBFCs, not specifically the banks, but that's the market we'll have to probably watch out for into next year. But this year, hopefully, given whatever data points we're looking at in the first quarter numbers, it seems that this year again should be broadly a below normal credit cost environment.
All right, below normal credit cost environment. Seems like you've been a bit of a good luck charm for the markets right now, Saurabh, because just as we speak, the intraday chart of HDFC Bank should come up for you at the high point of trade, sitting with a gain of almost 1% from the lows, currently 0.2% higher. And what it has done by its sheer weight on both the Nifty as well as the Nifty Bank, it's taken them higher. The Nifty Bank is sitting with gains of almost 80 odd points, so that's a firm recovery from the lows. And the Nifty too, from today's low, has recovered a good 70, 80 odd points, currently moved into the green for both the Nifty and the Sensex. The mid-caps perform a tad better, up around 0.25%. But Saurabh, coming back to the banking space itself, which segment do you think will drive growth for both private and public banks? Also, do you think this retail credit sort of theme is getting a little overcrowded? Could there be some sort of pain out there from maybe the unsecured part of the portfolio?
Yeah, so on the growth piece, this is one of the very rare times we are seeing more broad-based credit growth in India. So broadly, we have all pieces of the economy in some sense doing their share. So retail, SME, hopefully at some stage corporate picks up. But broadly, I think growth numbers across banks are better. They are more broad-based across segments. There is no excessive reliance on one or two credit segments, which has historically been the issue in the past. On the retail credit cycle, that's a great question. We have only had maybe two very small data points over the last 15 years in 2008 and broadly in 2020 on the unsecured retail. I would say given growth has only happened maybe 1.5, 2 years back, we are early in the cycle right now to see a cycle come in yet. It could happen. Obviously, that's the market will watch out. We think some part should come through in 2024, fiscal 25. So there should be normalization, but it will no be, as I said, this will not be anywhere close to what we have gone through as a sector or as an economy from 2015 to 2020. And that, so you should expect normalization of credit losses, but I don't think we are getting into a period as yet of above normal loss levels in the retail sector or in the SME sector. And part of that has to do with the broader digitization that the government has put in through RBI and PCI, the payments network, the GST network. All these are leading to two things. One is better underwriting outcomes across banks and NBFCs, and also in some cases, in many cases actually broad basing the market, both on retail and on the SME side.
Okay, Saurabh, well, it's been a pleasure. Thank you very much for joining in and speaking with us and taking the time out and giving your perspective on the banking space. That's the view coming in from JPMorgan. We need to take a break with the news that the markets have